Hello and welcome to a very special edition of Money Control. Retail investors are in a bit of a flux right now because they are facing volatile markets on both the equities as well as the fixed income sides. Equity markets has been volatile, as we all know, due to the ongoing Russia-Ukraine crisis. But even before the conflict happened, markets have been volatile since last October when the US Fed announced its decision to raise interest rates. At the same time, fixed income markets also have been volatile because inflation has been going up. There has been a lot of expectations of interest rates also going up. Central banks withdrawing the ample liquidity that they have been supporting the markets with during the COVID times. And now that we are nearing the end of COVID infection, central banks around the world, including India, are looking to take back a lot of that liquidity. So US Fed raised its interest rates. The RBI also raised its interest rates earlier this month. So, as interest rates go up, this puts pressure on the bond prices and they fall, and the NAVs of debt funds also fall. So as you see, investors have been facing a tough time both on the equity side as well as the fixed income side. So if an investor wants to invest in markets, where should she invest at the moment? Should she invest only in equities or only in fixed income or a bit of both? To make sense of this mayhem that's happening in the equity markets as well as the debt markets and how to make the most of it, we have two experts with me in the newsroom today. Please welcome Chirag Mehta. Chirag is the Chief Investment Officer at Quantum Mutual Fund, and Pankaj Matpal is a financial planner. He is the MD and CEO of Optima Money Managers Private Limited. Chirag has been with Quantum Mutual Fund for as long as 16 years, and Pankaj has been with Optima for the past nearly 11 years. Hi, Chirag, and hi, Pankaj. So, Chirag, let me start by asking you a very fundamental question. I mean, equity markets are in a tizzy, even fixed income markets are also in a tizzy. Investors are obviously in a flux right now. They are facing headwinds from both the equity markets as well as in the debt market. So, what is your reading about the how long are we going to see this kind of a volatility? Of course, the Russia-Ukraine conflict, nobody knows how long it will go. But how much of an impact would that continue to have on equity markets? And of course, we are now just starting to see a rise in interest rate cycles, not just in India, but globally also. So what do you make of this volatility, and how long are we going to, do we have to live with it?
So it's not that the first time that we're seeing this kind of volatility where both asset classes are kind of moving downwards. We have lived through such phases before as well. But if you look at what's causing this uncertainty is the bout of inflation, which is compelling central banks to act aggressively. I think central banks have been, to an extent, behind the curve. They have tolerated to ensure that we kind of move into a growth trajectory after COVID, and therefore they have been behind the curve to an extent. I think it was not very surprising. It was all baked in. We all knew that given inflation running wholesale at the wholesale level at about 10%, CPI at about 7%, it was given that they had to act sooner or later. And given that they have acted now earlier than what they could have done after some time, I think
Yes.
it will lead to its having its own impact and slow down the heated economy. Much of the inflation also supply side, but we always had that supply side constraints at some other the level when it comes to India. But now, if you look at Indian economy, it's kind of a bit sheltered because we are adequate on food. Other economies are even having that impact. So from an all perspective, much of the pain is kind of priced in right now by the markets. Markets are already bracing. If you look at the bond levels today, they're already looking at a repo rate of about 515 kind of levels. So much of that news that we will see going forward is getting priced by the market. And we have seen such phases before. Companies will pass it on these price pressures over a period of time. Maybe it will have a pain of a couple of quarters, but post that, they will ensure that at least the good companies or leaders will pass it on to consumers, and therefore equity markets will react to that kind of scenario. So overall, I think we may be in for more volatility, given we don't know how the Russia-Ukraine crisis outcome will be. If it kind of flares up or it subsides, but the inflationary impact will stay with us for some time. And maybe we could be looking at a quarter or two still for things to settle down. But if you have an horizon which is 2, 3, 4, 5 years, then probably it's great time to look at markets when they have corrected.
Pankaj, you deal with a lot of clients, and your main job is obviously to handhold investors, and I'm sure you must have had your hands full in the past 2 years because of the COVID crisis, handholding people through their money emergencies, financial emergencies, also investments. Now, obviously now we are at a time when we can reasonably say goodbye to COVID and the after effects. But just as when things were beginning to get on track, equity markets have been volatile, and because central banks around the world have been looking forward to withdraw a lot of the liquidity support that they have given to the markets, and also the inflation is rising. That's the big danger. So what is your reading of the equity markets right now, and how would all of these factors impact equity markets?
Kayezad, say inflation is rising, interest rates are high, geopolitical tension is there, crude prices are very high. So under these all circumstances, markets are expected to be volatile for quite some time. If we see right now that many stocks have corrected to 25 to 30% from their 52-week high. So I'll say it's not even a correction, it's a bear phase. And we have to live with this for around, say, if not more than at least 10 to 12 months. So markets are expected to be volatile. But when we think about investing in equity market, we always think about long term. So if you are thinking from the trading perspective, it's a different thing. From personal finance or from financial planning perspective, it's a time to accumulate. So if you are investing, means one thing is invest in staggered manner and have a longer horizon. So this is a time when you're getting good stocks at a good valuation, as well as if you talk about the mutual funds, even at a lower NAV, you are getting opportunity to enter. So it's a time to buy.
Okay. Have you been counseling your customers, your investors, Pankaj, over the last few months? Because markets had risen all the way to 60,000 levels, and people were also saying that markets are a little bit frothy, they were a little bit expensive. So in those kind of situations, take us how you have handled your investors and your clients, who had started to invest, because normally when markets are high, that's when people usually come in by busloads, right? So how did you actually handhold them at that point in time to make sure that when volatility comes, when volatility arrives, when correction arrives, or when a bear phase, as you rightly put it, arrives, they are not nervous and they are better placed to handle, the situation?
Kayezad, I agree with you. We have always seen that when markets are high, that time people enter because of expectation, because generally people see the past returns, and when markets are up, that time they can see that past performance is good, and based on that they start investing. And when market correct, which is the right time to enter, that time people have a little fear. But because if you ask about me, because I keep guiding investors, I suggest them that what should be done in the correct way, and it has been helpful. So and second thing, we talk about the financial planning, not about making quick money in the equity market. So when you talk about financial planning, it is goal-based investing. And when we talk about goal-based, so it is always like something when we are suggesting equity, it is something 5-year, 10-year, or longer than that. So based on that, then we suggest, if you are talking something about the 5-year, 10-year, invest in a staggered manner. So all these things together, longer investment horizon, staggered manner, diversification portfolio. These
and you also have to keep an eye out on your goals. Also, you also have to keep an eye out on your goals, because that many people also, when they invest, they say that, okay, which is the best investment to invest right now? How much yields would give me? How much returns would I make from this investment? But as you rightly said, that there is a better way, or more systematic way to invest your money for the longer term, is to ensure that first you fix your goals, and then you track the progress of how near are you to achieving those goals. Marginally, if you have achieved those goals, then your returns are automatically taken care of in the process.
exactly,
Right?
I agree with you. See, you should focus on your goals rather than the scheme or the returns, because there are in equity also we have different kinds of funds or different kind of stocks. So you understand that if a small cap or some mid cap, it will have more volatility, but in longer term you can expect better returns compared to broader market. Or there are sectoral funds or sectors specific, different kind of stocks also. Some are like growth stocks or some are value stocks. So you have to understand that for which goal you want to invest, and based on that you select the right products. So that becomes important. So most important part is, if you understand the importance of financial planning and you invest based on those goals, you make a strategy. So this thing will not come in between the your this thing planning. I mean, most of the time what happens, the people start investing in some stock which is already
which is already performed well, which is already done well.
So that is the right thing. You should understand that any stock will give you good return in long term. If the company is good, it will deliver. It may be a temporary phase. So based on that, you should make a strategy and you will make money.
In these market uncertainties, I mean, you've given us a good big picture view of how you handhold the clients. But you also said something, when I asked the first question, that this is not a correction, this is a bear market. Can you elaborate more on that? I mean, how should investors view this? I mean, is this, when you say it is a bear market, it is not a correction, are you saying that we are going to be in this phase for a little longer than expected? And what's the difference between the two? How should investors interpret that?
See, exactly, means when I'm saying bear market, because you have seen many stocks have corrected more than 25-30% from their 52 weeks high.
That's true.
And if you see next, it will take at least 1 year to come back to those levels or to get good returns in the market. So markets are expected to be volatile right now because we are in the interest rate rising phase. So it has started only. So we are expecting the next monetary policy again. There may be a more rise in the interest rate, or other factors are there, even the geopolitical regions, this Ukraine and Russia war. I don't know that how long it is going to last. So there are many factors. Considering those things, I'll say that right now I'm not expecting that. See, if suppose I say a particular stock has come down by 25% and it's the right time to invest, and so that I can make money in this. But there are chances that it can further go down by, say, 10-20%. So considering those facts, I will say that if you are investing right now, your horizon should be longer. That is one. Second thing, there should be diversification in the portfolio. And third thing, that you should be ready that if you are buying stocks or investing in funds, you may lose capital to some extent further. So keeping these all things in mind, you should invest in staggered manner. This is a time to accumulate, whether stocks or units. This is a time to accumulate.
Which is what I was going to ask you. I mean, you will advise investors even to continue investing even in these markets also, and not stop.
Definitely, this is a better time to invest actually. But as I said, you should invest in staggered manner. As I said, whether you buy units of mutual funds or you buy stocks, there are chances that stocks or units may fall down further. So considering that fact, I'm saying that if you have 1 lakh rupee, do not invest in all together in one lump sum. Better invest in staggered manner, but do not stop. Do invest. This is the right time. And see, good blue chip stocks or blue chip funds are available at a very reasonable price right now. So if not now, then when?
Okay. So coming to now, how to sort of make sense of so many investment avenues out there. I mean, you take a look at mutual funds, right? About 37 categories of mutual funds are out there in the market, where so many categories of equity funds are there. First of all, of course, and I'll come back to you, with this perennial question of active funds versus passive funds. I mean, that's where, that's the big debate in the industry right now among at least your community, your distribution community, and the financial advisor planner community. But we'll talk about active versus passive funds a little later. But tell me, how should one start off fresh investments in this market if somebody has not invested? I mean, we are in the month of May. I mean, a lot of this is the time that a lot of new people join, young people, millennials join the workforce, out straight fresh out of their college, out of the graduation. So give them an idea, give them a strategy as to how they should start investing. Should they start by investing in an index fund right now? Should they start by investing in an active fund, large cap fund? How should you make your first moves in the market when when the markets are ripe, as you said, for investments right now?
See, first thing, if you are investing first time and you do not want much volatility in the portfolio, so you can start with balance advantage fund or dynamic asset allocation fund. These are basically hybrid funds which invest in equity and debt, both asset classes, and the portfolio is managed dynamically. So fund managers, they decide that how much allocation should be in which asset class. So that can be one choice. Going forward, if you feel no, you want to invest for a longer term and you want to start with the equity, pure equity, so passive funds will be a better choice. You start with Nifty 50 or Sensex funds, means broader market, large cap based funds. So that will be a better choice. So I'll say that
Nifty Next 50 is also there. Nifty Next 50 is also there, right?
Yeah,
that
Nifty 50
also is
or
an
Sensex. That's what I said.
Okay.
So if you are investing equity fund, then definitely a passive fund will be better choice for a new investor who has never invested, planning to invest first time. But yes, your investment horizon should be 5 years or more when you are investing in equity funds, whether active or passive. But equity fund is equity fund. So start with Nifty 50 or Sensex. Better, I will say Nifty 50 because you have 50 stocks, or Nifty 100. So this kind of index fund you can start with, and with the investment horizon of 5 years or more. But if you want to invest little lesser than that, so that, as I said, you can start with dynamic asset allocation fund, or as I said, balance advantage fund.
So Pankaj, couple of questions. How to invest in equity funds, especially in these kind of markets. One is that you keep saying long term, and that many fund managers, many advisors say long term. Define what is long term. And second of all, how many funds, according to you, should be an ideal number to have in one's portfolio?
Yes. See, first thing, when I say long term in equity, my specifically 5 years or more, at least we start with the 5 years. So your long term financial goal, when we talk about financial planning, see, your financial goals will be something like something can be a shorter goal, like you want to buy a car or you want to build a house. But longer goals are like children education, their marriage, your retirement, vacation, this kind of long term goal. So for long term goal, which are at least 5 years down the line, so for those kind of goals, you should invest essentially in equity, because to beat inflation, I feel that equity is one asset class which has potential. So you should consider investing. So long term means 5 years or more minimum.
Okay, so nothing. So if you want to invest in an equity fund, let's make it very clear for our viewers, for our listeners. Nothing less than 5 years. I mean, if you have money to keep aside for 5 years only, then you go for an equity fund, right?
Exactly. That is what I say.
Okay.
Other financial planners may your idea, but I'll say it's 5 year minimum you should have for equity market, because anytime you may feel like market's correct and it take time to come back to those levels. So at least if you lose some capital, you should have time for that as well. So 5 years is minimum. That is what I recommend.
Okay. And Pankaj, how many funds should an investor have? And I'm not just talking about fresh investors. I'm talking about even existing investors, because we've seen portfolios as big as, let's say, 20 funds, 40 funds, 60 funds. The amount in each of those schemes might be very minuscule, but the number of funds are over a period of time are large number of funds. I mean, people have invested in almost every NFOs. Some portfolios I've seen every NFOs they would have invested in. So what is the ideal number of funds that you advise to your clients? No matter what age profile, fresh investor, existing investor, doesn't matter. But ideal number of funds, tell us how much people should have. 6 funds, 10 funds, 20 funds.
Kayezad, I'll say that investor who has a large size of portfolio and who have been investing in equity market, for them also maximum 10 funds, 8 to 10 funds will be more than enough. Okay, not beyond that. And why I'm saying, see, in equity market, if I'm talking about the equity funds even, if you say debt fund, there are 16 categories under debt. If you say equity, there are several categories. So why I'm saying several, not a number, because when you say large, mid, small, flexi cap, multi cap, then comes the sectoral fund. In sectoral fund also, there are different types of sectoral funds. So there are too many categories, too many types of funds available. But to an investor, what you need? For equity, you want large cap, you want mid cap, you want small cap. So suppose an investor has a larger portfolio and he wants to invest separately in one equity fund, one mid cap fund, one small cap fund, and say along with that he wants to have a sectoral fund as well. So considering these all facts, one may have 8 to 10 funds. But if an investor wants to invest a small amount, say he wants to start a SIP of 5,000 rupees. So instead of going for 8 to 10 funds or 4 funds, he has a choice of multi-cap fund and flexi-cap fund. So if you invest in a multi-cap fund, in one multi-cap fund, you get large cap, mid cap, small cap, everything. So that is why, depending on the size of fund, depending on the amount you invest regularly, based on that you can decide. But you can manage with a single fund as well, or maximum 8 to 10 funds, not beyond that.
You have, and I'm sure many financial planners speak about asset allocation. You have spoken about why this is a good entry point for investors to invest in equity markets. You have called it a kind of a bear run, and you said it's a good entry point. But the question we get asked often by our readers is that can I afford to invest everything in equities, or should I reserve something for fixed income, for gold as well, even if markets are attractive at any given point in time?
Kayezad, see, there's the importance for asset allocation. And asset allocation is the key to success of portfolio. So you must have all the asset classes in your portfolio, whether it's equity, whether it's a fixed income instrument, or gold or silver. You must have these asset classes. But yes, allocation in each asset class will vary from one investor to another investor or time to time. Because if you are planning for long-term goal, for example, somebody wants to plan for retirement. So in that case, if somebody starting at a young age, having 70 to 80% allocation in equity will be a right choice. But if you invest for a shorter goal, that time allocation equity should be very small. So when I said that it's the right time to enter in the equity market, because equity markets have corrected well, but it does not mean that you cannot expect further correction. So since beginning, I have been saying this. So considering that fact, even still, when the stocks have corrected 25 to 30%, many stocks from their 52-week high, still I will say that you should be much cautious about that, and you should maintain proper asset allocation and diversification in your portfolio. So any point of time, an investor should have a well-diversified portfolio with a proper asset allocation.
Okay. Noted. Chirag, now that you've explained us, how inflation impacts your investments, give us an investment strategy, to inflation-proof our investments. I mean, any particular instruments or any particular strategy that you feel should be taken up in an environment where inflation is high, possibly sticky, and looking to go up further?
Yeah, so inflation clearly has been a concern currently in all investments across, given that the raging inflation we have seen. So from a strategy perspective, if you look at value funds, for example, because whenever there is a high interest rate environment that we're getting into, usually high growth stocks tend to suffer. Even if you increase the discounting rate of companies at which you kind of discount the cash flows, even from that perspective, high growth will suffer more than a low growth company. So to some extent, there is an impact on high growth stocks to an extent whenever you're seeing interest rate increases. So from that perspective, high leverage companies, high growth companies will tend to suffer because they're already at a higher valuation, pricing in the growth that markets were pricing in. So from that perspective, if you look at value funds, for example, or value stocks, they would be in a better environment. If you look at the era of 2003 to 2006, where we had a similar kind of market environment where we had higher inflation and we had a increasing interest rate environment. In that point in time, also the value stocks did well. In the last leg of the rally, we did see growth stocks coming back to the fore. But until then, value stocks were really doing well because in such an environment, there is price increases taken by companies, which they kind of pass it on. And over a period of time, there is earnings growth that we are seeing, not only on a real basis, even on a nominal basis, because of high inflation, it kind of runs high. So from that perspective, I think value could do well. Quality companies would do well because there is that pricing power, given these are leaders in their own sectors. So overall, from that perspective, I think value and quality from an equity market standpoint would do really well. From an overall portfolio perspective, I think the diversification that you need, because in a high inflation environment, we have seen that over a period of time, gold kind of helps in such environments, given its property as a store of value. As we see inflation kind of normalizing and then gold price catching up, that is a trade that you could look at from a diversification perspective. So overall, from a portfolio standpoint, we kind of have seen over cycles that an allocation of 12, 20, 80 works really well, where you have 12 months of your expenses, 12 to 24 months that could be of your expenses kept very, very safe, and rest of the portfolio split into 80 and 20. And within the equity portfolio also, you kind of diversify across different styles. And in this kind of market, value and quality will be standout performers. So if you can identify funds within that basket, then I think you would be placing your portfolio really well to take advantage of the cycle that we are getting into.
So Chirag, value funds, of course, I mean, they have been around in our markets for decades and decades. But, we have seen value funds underperform for a very, very long period of time. Investors appear to have been losing patience. Even just when the COVID rally began, they were one of the worst performances. It's only as the rally progressed in 2020, as markets went up, value funds actually came back. After 6-7 years, people had seen money being made in value funds. Is that the normal cycle that people should expect even this time around, if you're saying that this is the right time for people to enter into value funds? Is that the minimum holding period? Indirectly, are you saying that?
So if you look at any style will go through its own cycle, and value also had a very bad cycle from 2017 till 2020 until COVID. Until 2016, value was doing really well. And post that, we entered into an era where we saw a lot of liquidity being pumped in by central banks. We saw interest rates being driven to zero levels. In such kind of environments, usually the growth stocks will do well. Now we are entering into a market scenario which is completely different environment, where inflation is high. It's a completely different environment, and we've seen that in such kind of environments even before, when there is a rationality in markets and there is a earnings driven rally, value tends to do well. If you look at the period from 2014 till 2017, which was a good rally in markets, earnings growth was very, very tepid, and that is where value didn't perform really well, because it was more a PE expansion market where growth kind of stocks were doing well. We are entering to a period similar to 2003 to 2006, where there is an earnings growth happening in companies. So post-COVID period, we have seen good earnings growth for companies, which was not present in the 5 years prior to that. There is a bout of rising interest rates, which will not be conducive for growth kind of companies. So markets will also kind of fine tune their expectations and move into more pockets where there is value emerging, which has a cushion available. And that is when I think values should start doing well. So there are similar levers that we saw in 2003 to 2006 rally. We are seeing that similar kind of environment, and value did well then, and value should do well now.
So Chirag, you said in your previous answer that strategies that investors need to follow, among other things, is one is value-oriented strategy, value funds, pick value funds. You also said about quality. Now, with regards to quality, one thing that comes to our mind is that we've seen a broad-based markets rally in the past 2 years. But before COVID had set in 2 years ago in 2020, markets had for the longest period of time gone up in a very narrow fashion, with about only 6 to 7 to 8 to 9 companies were driving up the markets. So when you are saying that going forward we have to stick to a quality regime, are you saying that the days of the broad-based market rally is behind us, and only a few select stocks are expected to do well? Is that what people can expect from markets going forward?
No, not really, because we think that we are on a cusp of an economic revival overall. And from that perspective, I think there will be good economic growth, cyclical recovery that we will see continue, which got kind of pushed back because of the inflation increase that we have seen. So from that perspective, there will be all kind of companies that will kind of catch up over a period of time. But initial part, when we are bracing through that high inflation, only good quality companies that are leaders in their sectors will be able to get that price increases and therefore come to a normalized margins earlier than most of the other companies. So from that perspective, looking at quality companies from this inflation scare perspective, those kind of companies will be less impacted because they will have that pricing power and therefore do well in the initial part of the rally as well. But over a period of time, we think that given the economic growth environment that we are going to get into, there will be a broad-based rally. But of course, there will be pockets of
Okay.
where we think it will be much more conducive environment. For example, industrials, or be it financials, or be it consumer discretionary sectors, materials, utilities. Those kind of sectors will really do well as opposed to other sectors.
Okay, okay. And what are the drivers for corporate earnings growth going forward? Chirag, as a fund manager, what would you be looking at?
So, if you look at the external environment, there are three big drivers that we are looking for from a growth perspective that will push the growth upwards. One is we are looking at good pickup in residential activity across the economy. So given where the affordability stands, even if interest rates were to increase, we are still, from a historical perspective, the affordability is at a very, very good level. If you look at from a EMI to income perspective, it's at one of the lowest areas that we have seen. Maybe around 2002, 2003 was a similar kind of level where we had from an affordability perspective. Second is IT sector has been doing really well. There has been significant pickup in hiring there, which we think will continue. And there is also a wage growth associated with that, which will also help, again, the residential or real estate activity in the economy. And third is the government capex cycle. If you look at the government spending program has been significantly large. So that will also help revive the economy and possibly revive private capex as well over a period of time. So these are the three big levers that we are seeing, which we are hopeful, which will pull the economy into a recovery mode. And that these are the areas where we think the growth will be. And to play this recovery theme, I think the sectors that I mentioned, industrials, financials, materials, utilities, and consumer discretionary with a lag, will kind of do well given these levers that we are seeing.
Okay, okay. Chirag, I think we are running absolutely out of time, but I can't let you go without asking one question on gold, because you are, after all, one of the most authoritative voices on gold out there. So tell us, what role does gold play in an investor's portfolio, especially at this point in time? Because, gold prices have also gone up by leaps and bounds, 2 years, 3 years, ever since the past 2 years, 3 years, 4 years. But, it sort of hasn't really stuck to the script despite the ongoing Russia-Ukraine conflict, right? I mean, we have seen volatility even in gold prices also. So where do you see gold prices going from here on, and how should investors plan their investments in gold? And third, how much of gold should everyone have in their portfolio? I mean, is there a minimum and a maximum band that you recommend to your investors?
Sure. Thank you for the compliments. Firstly, I think it's much really appreciated coming in from you. And if you look at gold, I think plays an integral role in the portfolio, because it is one of the best known diversification tools available for an Indian portfolio. So from that perspective, whenever we have seen time and again, equity markets have taken a hit, gold has helped portfolios generally speaking. So overall, gold is an essential part of the portfolio. given that from a view perspective, there are conflicting forces impacting gold markets currently. If you look at one end, we have high inflation, geopolitical conflict involving Russia, Ukraine, and many other geopolitical hotspots. But we haven't seen an escalation to drive that factor into gold price valuations. So from that perspective, it has not lived because there has been no escalation of the conflict beyond those two countries. So inflation, real interest rates remaining low are supportive factors for gold. At the other end, we have seen central banks getting aggressive, which is helping dollar. So we've seen rate increases. We have seen more tightening coming, and we also have a stronger dollar, which is putting a pressure on gold. So these two conflicting forces are keeping a range-bound movement in gold. But we sense that as central banks will want to reflect on growth whenever growth slows down, and they will take steps to take a U-turn, because they might be staring at a policy error, because much of the inflation today is supply side. And when you try to curb inflation today, you will hit demand. And when you hit demand, the growth slows down, which will lead them to making a policy error, and therefore U-turn on their policies. Whenever we see that U-turn, I think we will see a good repricing in gold. So until then, expect a range-bound movement. Could be 3, 6 months, 1 year's time frame. Gold could remain range-bound. But whenever we see a U-turn in policy making by these central banks across the world, you will see gold getting repriced. So gold will generally test your patience, but whenever it moves by a margin. So you'll have to be patient with your investments. But from an allocation perspective, hard numbers suggest that 10 to 15% allocation in gold is important for your portfolio, because it does not impact overall portfolio returns. It kind of enhances it slightly, but at the same time, it reduces your risk significantly. So 10 to 15% allocation is what usually one should have for your portfolio.
Okay. Thank you, Chirag, and thank you, Pankaj, both of you all, for your very lucid, simple explanation of what's going around in the equity markets and the debt markets. And I'm sure investors, our viewers, readers would benefit a lot from your analysis, and hopefully, get a clear signal or a clear vision as to how you should be investing in your money when both the equity markets as well as fixed income markets are volatile. So thank you so much, both of you all, for joining us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.